Hi, I'm George Nordhaus, and welcome to Monday Morning. Today we are going to have one of our most prolific presenters, Al Diamond, talk about something that's near and dear, or should be near and dear to every agency owner's heart, which is agency valuation. What is my agency worth? And I want to find the best guy I could find in the country on this subject, and I found Al. And I really believe that. He's going to talk about how and why you need to do this. And I'm going to tell you, this is probably one of the most important Monday mornings we'll have now and in the future. So pay attention, look at it, make sure it gets to other people. And, well, I won't take Al's time. Al, let me see your bio here just for a minute, although I pretty well know it, and your picture, if I may. He's been around a long, long time. Al and I have been working together literally for 40 years, something like that. He's expert witness. Agency Consulting Group has been working for 45 years. Holy mackerel. Al writes something called, and so he gets around. He's probably one of the most well-known consultants in the country, but he also gets around to speak. He's excellent to speaker. Well, you're going to find that out if you don't already know. And he also is the author of The Pipeline. And if you don't subscribe to The Pipeline, you should. There's like 5,000 people on that list. And it's a wonderful, wonderful monthly newsletter. To me, I read every issue of it because Al goes to the heart of the matter, as you will see. All right, Al, what are we going to talk about today?
Well, thank you, George. That was a very nice introduction. What we're going to talk about today is valuation of insurance agencies. Everybody seems to know how much their car is worth. Everyone knows how much their house is worth, but very few of us know how much our business is worth. The old timers among us, and I get calls from them every day, assume that it's worth 2 times something. I have no idea what that multiple is about, but it's a nice, simple way of expressing a value, and they try to retire based on that. Unfortunately, no 2 agencies are worth the same amount because no 2 agencies act the same way. And so the order of events that I'd like to go over this morning, number 1, why bother with evaluation at all?
Mm-hmm.
And then, of course, how much is my agency worth, or if I'm in an acquisition mode or merging or associating in any other way, I need to know how much mine is worth and how much somebody else's is worth.
Mm-hmm.
Then we want to find out whether we want to do it ourselves or use a specialist, because this is not brain surgery. I'm a pretty simple guy, and the same methods I use can be used by an agency to value their own shop. Then we're going to talk about valuation voodoo. Valuation voodoo is what I call the multiple methods of valuation, where they try to tell you that it's worth 2 times income or 2 times commission or 2 times or 5 times EBITDA or some feature of a multiple, trying to say that 2 agencies, one in Indianapolis and one in the heart of Los Angeles, are worth exactly the same amount if they're exactly the same size. And we know that's not true.
No, of course.
Of course not. So that's what we're going to do today. I think we can do it in a fairly concise manner. The first question, of course, is why bother with evaluation at all? And my answer to that is you're insurance agents. I mean, you specialize in helping people protect their own assets. How do you protect an asset that you don't know the value of? And so if you're helping them, then what I ask you to do, please practice what you preach. Protect your own assets, identify what they're worth, whether it's your insurance agency, your home, your property, anything else. Practice what you preach. The reason that we need it, of course, I don't care how old you are, whether you're 30 or 65 or 85, you need to do estate planning. We hope to live long lives and retire and have a good time with our remaining years, but we can never tell when we get hit by a truck crossing the street. Estate planning is necessary, and you need to define the value of your agency, whether you're the only owner or whether there's a slew of owners in the agency. Perpetuation planning. Wouldn't it be nice to be able to tell people who may become your successors how much they are going to have to kick in order to buy the agency. They should know that at some point in time. And if you're not going to have successors locally, you need to plan your retirement based on the value of your major asset. And for most of us, the agency is the major asset. Partner buy-ins and buyouts. We are doing an awful lot of these days, bringing producers and other managers and agency staff into ownership, and then buying out retiring owners. You need to have a valuation for that. It can't just be a formula. It needs to know how much the actual dollar amount is. And know what it's worth when someone makes you an offer. I had a phone call this morning from an agency with a target on its back. It is a brilliant, wonderful agency in a part of the eastern side of the United States, growing at a 10-15% rate, and at a $3 and $4 million commission level. I mean, this is, and they get calls probably 3 or 4 times a month. Offering checks, just throwing money at them. If they don't know how much their agency is worth, they never know whether it's overly generous or an accurate representation of value. All of these are examples of why you should bother with a valuation of your agency, and frankly, you should do it on a fairly regular occasion. Lots of agencies do it annually, and even more do it every 2 or 3 years to keep up with what their agency is worth, whether more or less.
Right.
So the next question, obviously, is how much is an agency worth? Well, we split this into a couple of statements. First of all, the statement on the screen now, what you or someone else can earn by operating a business over time, is the government's statement of value. And this is not mine, and this is not just for insurance agencies. The value of any business is what you or someone else can earn over a period of time for that business. A reasonable period of time. To me, reasonable may be 3 years. George, to you, it may be 10. So, so a business could be worth more to you than it is to me, and that's why when you have 5 people looking to buy an agency, that you may have 5 absolutely accurate different values being expressed for the agency, because each one of the buyers is looking for a different thing. Now, the fair market value is described by the Internal Revenue Service. That's the amount that a willing buyer and willing seller agree will cause a business to change ownership. That's fine, but it's a platitude, because if you try to sell your agency for $1 to your son because you agree that that's what it's worth and he agrees that's what it's worth, I promise you the IRS will be visiting you. It's not a fair market value from the standpoint of taxation. So you need to have a statement of value that expresses that fair market value. If the seller isn't willing to sell it at that price, it's not fair market value. If the buyer isn't ready to spend that kind of money on a seller's asset, it's still not fair market value. Now, we've just discussed value. The price of the business is even different than that. Now, we can express value, but the price is going to be negotiated between the buyer and seller. There are abnormal risks and returns. What's an abnormal risk? What happens if the owner of the agency is the controller of the agency's top 20 accounts? And if he goes away, so could they. The buyer may lower the price of the seller or negotiate that price accordingly. On the other side of the game, what happens, George, if your agency and my agency are the only 2 in town? And I'm getting ready to retire and you're going to buy out my agency, you'll be the only game in town. That could actually boost the value to you of buying me, because you're not going to risk people leaving. There's no place to go.
Got it.
Those risks or rewards will discount or enhance the cost to the buyer. Now, we're going to talk about discounting in a few minutes, and I promise you, all the agents listening to this, pay attention to the discounting of values, because that's where most of you fall into a pit and can't get out. You have to accurately represent the discounting feature of an agency. Now, within our insurance agencies, there are two major forms historically: stock sales and asset sales. Stock buys the corporation. It's appropriate for a lot of internal perpetuation. I've seen them over and over again, but I promise you that there are better ways of doing it than stock sales, even internally, for some companies. And it's not appropriate in most acquisitions. Most acquisitions that we make every single year are asset purchases. It may be right, stock purchase may be right for a merger, especially when you're considering a tax-free exchange. Go see your accountant or tax attorney or talk to us, because we can merge two agencies with no tax implication at all. And of course, a stock sale buys liabilities as well as assets, and that's one reason that you may want or not want to consider a stock sale for your agency. Now, going further, you got to decide whether you want to do it yourself or use a specialist. Can you do it yourself? Absolutely. This isn't a terribly complex situation. But should you do it yourself? Well, probably not. It's much like the person who knows how to tinker around with his car or who knows how to make repairs to his house. Does that mean that he's going to rebuild his engine? Or does it mean that he's going to build his own addition onto his house? It could be done, but you're probably going to trust a specialist because they can do it better. But should you understand how to build a house, how to fix the car, or how to value your agency? Absolutely. The educated agent about the value of their own agency is our biggest ally. When we value an agency, I want to talk to that agent on a continuing basis. I want to explain to him exactly what we're doing, and our valuations are very deep. They are sort of heavy. I mean, they often come out between 30 and 100 pages, but that's because we give them, for their purposes and for purposes of their accountants, attorneys, or the IRS if that comes into play, all the documentation we use, all the methodologies we use, there's nothing hidden.
Al, let me ask you something just a second. When you do an agency valuation, you said that some agents do it annually, some agents do it every 3 years, some agents don't do it. It gets easier for you, doesn't it, as specialists, when you go in the second time or the third time? Do you get called back to those agencies on a kind of a regular basis?
We have done hundreds of agencies that we do on an annual basis for the last 20 years.
Oh.
The cost of doing a valuation is fairly, well, it's moderate for us because we do so many of them initially. But we have to put a lot of time and effort into doing that first valuation. After we do that, we have all that data already in our system.
That's what I thought.
And every year, all we need to do is update 1 year worth of data. And so we can charge a lot less for revaluations. That's why so many agents do them on an annual basis.
Okay.
If we had to charge what we did for an initial valuation, you'd be foolish to do it every year. You don't need it every year.
Got it.
So the revenue ruling 5960 is the genesis of valuation, not just for agencies, but all valuations of businesses. So you'll hear this often, but I wanted to show you the 8 factors that any valuer, whether it's a professional or you, have to take into account when doing a valuation. And the first 4 are here. It's the nature of the business, the economic outlook, both in the area or for the insurance industry in the area. When you take about coastal risks in Florida or the poor economy in some cities in Michigan that are trying to get back on their feet, all of this has to be taken into account. The book value of the stock and financial condition of the business is viewed through their balance sheets. So you have to look at the balance sheets and understand them on every agency. The earnings capacity of the company is what you feel, what you can pro forma for that company into the future. The dividend paying capacity of the company is what it can throw off in terms of profits after the fact. Of course, in an LLC acting as an S corporation or in S corporations, that's notwithstanding because all profits flow through the company directly to the owners. However, in regular corporations, you're paying tax on those profits. Is there going to be a dividend paying capacity or not? Whether or not the enterprise has goodwill or intangible value. As you know, there's arguments going on consistently throughout the United States and Canada about the intangible value, the goodwill value of agencies. We can show in every single case, we can show that there is goodwill value. There are intangible values. In some agencies, they're enterprise, and in some agencies, it's personal goodwill, depending on the type of agency. The sale of stock and the size of the block to be valued is more important in other businesses than it is in the insurance business, because most of our businesses are sold to closely held other businesses and you don't have a track record. And the ones that are sold where you know how much the sale is are usually the biggest companies selling to other big companies, and it's very difficult to compare a small agency to an agency that is 10 or $20 million of revenue. Mm-hmm. The market price of stocks and corporations are there. Those are the comparisons that are being run. Easy to do for the brokers who are and conglomerators who are buying hundreds of agencies. Not easy to do for the individual agency.
Got it.
So, down to the real nuts and bolts. What's my agency worth? 1 times, 2 times, 3 times, and no matter how many times I do seminars on the subject, I'll always get 5 or 10 or 15 calls a week asking me what the current multiple is. And my question has to be, a multiple of what? The rules of thumb that have been going around the industry include multiples of revenue, that's all the dollars that flow through your agency, multiples of commissions, well actually that should be commissions and fees. That's a multiple of operating income in the agency. Then there's a multiple of earnings, and that is after tax what comes back to the owners of the agency, and the proverbial EBITDA, earnings before interest, taxes, depreciation, and amortization. Originally, it was supposed to be a cash flow projection, but it got bastardized, so it's not all cash flow either. All of these, unfortunately, can be created and recreated. So I can take any agency and make that agency be worth a multiple of revenues, commissions, earnings, and EBITDA to whatever degree you want. The actual value of the agency can't be done this way. I call these things valuation voodoo because people who are probably good accountants or good appraisers of other businesses are trying to sell you a valuation letter that tells you that your agency is worth a multiple of 2 times revenue, and they charge you for that. And there's no basis for that information besides what they find on the internet, which you can find as well. So whenever somebody asks me that, I ask them, well, you want to know what the value of your agency it is? It's $10,000 times the number of chairs in the agency. When I say that, I get one of 2 responses. Either they hang up on me, which is okay, I have too many friends already, or they tell me I'm crazy. They said, how on earth can you value an agency by the number of chairs? I said, look, it's the same as revenues or commissions. All I need to do is add more chairs if I want more value. But if I add more revenue or more commissions this year, does that mean that next year I'll still keep them and my value goes up this year? I don't think so. So what I'm trying to explain to folks is that the value, the real value of a business is its future earnings potential over a period of time under specific circumstances to the person creating that valuation at the time that the valuation is being done. So if you are the owner of your agency looking to determine what your current value is, you're saying, here's what I've done in the past, here's what I expect to do in the future. If I do what I expect to do in the future, here are the kind of earnings that I'll do 5-year period or 7 years or 4 years, and that's a reasonable value for my agency, and that's what I get life insurance for, to protect my wife and children. So how do you figure future earnings if that's what you're looking to do? Well, you start by historical trends on revenues, on expenses. You adjust for expected changes, and here's where you calculate risk factors, and we're going to talk about that in a minute, and determine how long you're willing to give up the earnings to buy the agency. This is on an acquisition. The revenues and expenses are looked at on an individual basis. You don't look at them as gross income. Too many things can change. What you look at them on is P&C commissions, contingencies, life and health income, even the investments that you make, and fees. And fees in some parts of the country are becoming a phenomenally important part of our revenue stream. That's why I said operating income used to be just P&C commissions. Now it's considered P&C commissions and fees, or P&C and life and health and fees. And the other income that you may be generating from the agency, we look at trends on all of them. When we look at historical trends, we don't look at trends of total expenses. We look at trends on every single line of expense, compensation being the most important one, executive management compensation, historical trends, sales compensation, and office compensation. What happens if you're going to lose an executive? Well, your future trend may not be the same as your historical trend. Also, you've got to look at the costs of employment. Costs of employment are broken into two categories. It's all the employee benefits that you use, not just health insurance, although that's a big part of it, but any employee benefit that you provide to your client, to your employees, plus all the payroll taxes. And they differ, of course, state by state and locale by locale. Sales expenses, you look at each one of the primary sales expenses, historically, T&E, auto, and advertising, and you project them into the future. Same thing with operating expenses and administrative expenses. Operating expenses are the expenses that have to do with the operation of the agency. Administrative expenses are expended whether you're in an operating agency or not. So, you take all these trends and then you make adjustments. You're looking at every line of revenue and expense and building a pro forma view of the future income and expenses at least 5 years into the future. And what you're doing is you're saying, if I now own this agency instead of George, if you own the agency, what do I expect to have different? Well, George pays himself $1 million a year. I probably won't. So I'll take a little bit less and I can pro forma that out, because all of those adjustments determine pro forma profits. And we adjust every line by known or expected changes, except we never bet on the come. things that are that the Las Vegas folks and the Atlantic City folks like to do, draw to an inside straight. We don't do that. So we don't expect that just because he has a large P&C volume and very little life and health, that we'll be able to write life and health on every one of those. That's not a part of our projected adjustment, because we don't know whether he'd made an arrangement with another life agent 5 years ago or 10 years ago, and life is being written just not through this agency. So you don't bet on those. Now, risk factors. We have, over the last 25, 30 years, developed a list of 195, I think it may be 196 now, risk factors that are involved in agency operations. When we do evaluation, there's a long questionnaire. Most of the questions in the questionnaire and most of the conversations we have with the agent is made to identify those risk factors to determine whether it's more or less likely that that agency will be able to fulfill its earnings potential. The first risk factor, and it's the only one that can be published, that can be every day, is the time value of money, the 10-year T-bill rate as published. That has been down as low as 1.8%. It's been hovering in the 2 to 3% bracket, and we know that future earnings potential of the agency will be discounted by at least that time value of money, because every year the dollar's worth a touch less. The other risk factors are categorized in several categories. Risk factors pursuant to the carriers that the agency has, to the clients that the agency has, to the agency staffing. Big difference between having 30-year-old and 40-year-old employees and having, as a 70-year-old owner, having all of my employees in their late 60s and early 70s. Those three and many more that fit within that, like I said, there are almost 200 of them,
Wow.
creates a subjective discount rate that's applied against the raw earnings potential. So once you get an earnings potential that says, I ought to be able to generate $1 million of earnings from this agency over the next 5 years, and George, I'm willing to pay those earnings to you to buy the agency. So at the end of 5 years, you're paid off, and everything now belongs to me. I subject those raw earnings to this discount factor that says, because of the risks involved in the agency, here the likelihood of my getting all those earnings go down by 10% or 15% or whatever that subjective amount is. I've seen them as low as 5% risk factors, including the time value of money. I've seen agencies that were functionally bankrupt with risk factors as much as 50 and 60%. And everything in between. That's why you have folks like us who do this for a living. But if you know your agency well enough, you can identify your own risk factors as well. So how long are you willing to wait for your piece of the rock? Well, the value to you is equal to the discounted earnings potential for as long as you're willing to wait to get your full share of profit. That's why there are some agents who we work with on a regular basis who say, look, I have a 3-year window. I will always buy agencies, but no more than, I won't pay for them for more than 3 years. At the end of those 3 years, I have to have all of my income. Big difference between that and the son of the agent who says, I'm willing to give my dad whatever he wants because I'm basically getting it for nothing. And so I'll pay for this agency for the next 10 years or 15 or more. And those agencies are worth a lot more to son than it is to the guy who only wants to pay for it over a 3-year period or 4 years or 5.
Right.
So valuation is as important as your annual checkup. And that really is true. You and I both know a lot of folks, George, that if they're not smart enough to get an annual checkup, they don't need a valuation either because they know that someday they're going to die. And if you're lucky, it'll be quick and someone else will have to deal with the agency's value and with the agency. However, if you plan to live and enjoy the value of your asset, if you don't want your wife or your family to try and figure out what to do with the agency when you're taking harp lessons or the reverse, then if you care about your staff and you care about your clients, something that many agents feel very, very warm about, then you need to value your agency. You need to value it this year. The cost, there are some pricey valuations out there. It depends on the size of your agency and the complexity. But we do so many of them in a given year that our valuation costs are probably among the lowest in the industry at this point, and we still make a few dollars on each one. But the annual revaluation costs are dead cheap because we only have to add 1 year's worth of data. So that's what we do. We have a product, if you want to try it yourself, called the Agency Valuer that we'll send to you. You can try it. If you figure out that you're a much better insurance agent than you are a valuer of business, we'll credit the cost of the valuer to your full valuation. And we'll be more than happy to answer any questions you have about agency values. It's a shame that more agencies don't value their businesses on a regular basis. It would give you and your family a lot more security.
Al, I can tell you this, that I didn't, I usually comment a lot. I was very quiet today because I was learning. Every time I listened to you, I was learning. I think this is the most succinct, accurate presentation on agency valuation that certainly that I've ever seen. I want to suggest to agents that you take this, that's your principles, really, really, really study it. I also want to suggest to everybody that you do subscribe. You see it there at the bottom of the pipeline, and that is an excellent, excellent presentation every month that I learn from constantly. And I looked at that agency valuation one time, and it was way over my head, Al. And I knew I couldn't do it for the people I was working with is in marketing consulting. But anyhow, I think it's pretty phenomenal. What you've done here is establish the situation in the United States, I think, for valuation of agencies that a lot of people would love to be in your shoes right now. So I want to thank you for doing this in 30 minutes. You have covered more space than more more information than anybody could have in hours. So let me just thank you again. Let me suggest again that people get hold of you because you are very cooperative communicating wise. And any last moment thoughts, Al?
No, just give us a call, ask questions. We're more than happy to talk you through the entire process. If you're questioning whether you can do it yourself or not, we'll explain it to you chapter and verse. And if not, please consider doing it this year. It's really, really important that you know this.
Thank you, Al. And for the rest of you, I'll see you again next Monday morning.